Let's segue into the hot topic of the day. Look at the mortgage news daily. Get today's rate as we recording this, April 13, almost tax filing day. Look at the mortgage news daily rate. 30-year fixed rate mortgage, 7.3%. And we're talking about owner occupied type of mortgage rate. We're not even venturing into an investment loan rate. Of course, the other VA is a bit lower, or FHA is a little bit lower. But Richard, tell the audience, let's say, this is amazing, right? We used to have 2.5% mortgage rate like 3 years ago in 2021. And now the mortgage rate has tripled, which is mind-boggling. And yet the mortgage rate has tripled, and yet housing prices have not gone down. Read my lips. The housing market does not crash just because of how high or how low is the mortgage rate. Richard, tell the audience what's going on. Dispel all the misconception. Dispel all the crash porn bros out there that have produced crash videos every single freaking day to attract those uninformed and unsophisticated people watching the YouTube video, getting all kind of subscribers, all kind of views, and they destroy people's American dream by watching crash forums. That's how they do it. So let's dispel all that. What does if today's mortgage rate, according to Mortgage News Daily, people with good credit, people that have 765 scores, for people that have 25% down payment, they can qualify for the 7.3% mortgage rate, assuming there's no funds buy down, whatever. For investor loan rate, if you do not have any kind of buyer incentive, giving the 7.3% mortgage rate indicated by Mortgage News Daily, an investor most likely have to pay almost 8% to get an investment loan if they buy it in a market, in a property on their own without any kind of incentive. Can you go through this amazing comparison?
Yeah. So first thing first, as you alluded to, is rates are here to stay. Most people are waiting for this drop to happen before they start getting back into the market. And as we discussed in one of our other slides, Fannie Mae just released their rate guidance through the end of 2022. And the projection for primary homes is dropped to 6.25% in the next year and a half, which is barely a 1% drop over today. So first thing first is waiting for this big change to happen and this big drop to happen before you take action. It's not going to happen. And this, where we are today, may be 1% lower than today is the new normal. But what's been interesting, as you stated, even with interest rates tripling over the last 3 years, real estate has still remained robust. It's gone up. You would think that it would go down. If the price on any product triples, inherently, you would think that the price would go down because it would be less demand. However, what we've seen is there's such a supply and demand crunch currently nationally that even though the cost of the good, the home tripled, there's still more demand than there is supply. And that's really what's driving the market. As the crash bros, they've been wrong already for 3 or 4 years straight, if not longer. And whoever has waited and has been waiting to buy a home is kicking themselves in the foot. Guess what? Interest rate or not, economy or not, there's a supply and demand issue, which will continue. And some people get in the argument, it's the hedge funds that are buying the homes. And I was like, that's nothing to do with roofs over heads. Who's buying it has nothing to do with the fact that there's not enough roofs over heads. And that is the problem. I'm not saying, okay, there's not enough for primary home buyers to buy because hedge funds are buying. Sure. Okay. I'm not going to argue that. But that's not what's causing the house prices to go up, because they're not keeping them vacant. They're putting tenants in it. But there's still so much demand for roofs over heads that, and you go to whitehouse.gov, you can Google it, go to Fannie Mae. We're short like 6 million homes nationally. And if they started catching up today, it would take 10 years to catch up. But they're not building enough homes. So that's going from 5 million to 6 million to 7 million to 10 million. The housing shortage is here to stay. It's not going anywhere. And that's why real estate prices haven't been grossly affected. Yeah.
Yeah. If you look at, if anybody look at Redfin, the website Redfin or Realtor.com, during the pre-pandemic, before 2020, there were like 1.2 million single-family homes available, listings available. Now, even though this past couple of months, there was a 25% increase inventory from last year, 2023, we are still at half the amount of inventory that we have prior to the pandemic. So there's still a shortage. We are percent short based on the benchmark of a balanced market. So furthermore, here's the thing. Just 2 months ago, one of my realtor friends in the Bay Area where I live, Tony Bruno, we've done some videos together. Some of his listings a couple of months ago in Fremont, I used to live in Fremont a few years ago. One of his homes were listed MLS that he's the listing agent. The homes were $1 million initial list price. Cookie cutter home built in 1940, a 3-bedroom, 2-bath, like 1,100 square foot single family home, decent backyard, whatever. And then this home had about 10 offers. 10 offers just a couple of months ago at the beginning of the spring buying season in Fremont, California. And out of the 10 offers, the highest offer was like $1.3 million, $300,000 above the list price. And they were 2 all-cash offers for $1.3 million, 1.325, something like that. So we're seeing multiple offers. We're seeing bidding war on a home, on a house that are well priced, that are in good condition. I know Bay Area is a little bit different. I know there's a small sample size, but you live in Southern California. I'm sure you'll come across people who know realtors in local area in Southern California, in LA. Same thing. We are seeing in Orange County, in good areas of LA. You're seeing 5, 10 offers per house even today, even with the elevated rate, even with a rate of 7.3%, people are bidding 5 to 10 offers in a decent location in Southern California. And a lot of these are all cash offers. Look, California is different than the rest of the nation. I get it, but you can make the argument that, like you said, home price housing market is still very resilient. And we could continue to see what this seller's market and we talk about 5 to 6 months of inventory is balanced market. Nationwide, we only have 3 months of inventory. In a seller's market, I don't care what anybody say. Furthermore, I look at the San Jose data, the month-to-month data. I look at the month supply of inventory in San Jose and Fremont and in many areas of the Bay Area. There are only like 1.5 months of inventory. There are so few homes available for sale. It's a locking effect. 90% of the nation's home mortgage holders have mortgage rate below 6%. Don't quote me exactly, but like 50% of mortgage holders have rates below 5%, and 25% of loans have mortgage rate below 3%. This lock-in effect are not going to go away for the next decades, in my opinion. So we can have, like you just said, 6 months no supply, 6 million short of homes. We're not going to see a crash based on this data. And also, the labor market is strong, and the inflation numbers recently is very high. That's why the rates are still very high, excess of 7%. But the job market, unemployment is very low. Job market is very robust. Economy is very good. The economy is very empty. So what is the disconnect? Why are people still on the sideline? People, investors, like you and I, we focus on investors. The homes that we present in Midwest is only cost like 50 to 100 grand. You have 25% down payment, you can cash flow in the Midwest market. If you have in Florida, in Texas, that we're promoting, that you and I are very familiar with, we're only buying an entry-level investment home. We're not buying a $500,000 or $800,000 single-family homes. If we buy a 100 grand or $250,000 investment home, the difference between 6% and the difference between 5% rate and 7% rate on a small purchase, like $100,000, $150,000, is only like $50 per month in cash flow. That's nothing. That's not a red flag to not buy. That's no reason for investors, especially, to stay on the sideline. It's just ridiculous, because if you stay on the sideline waiting for mortgage rate to come down to 5%, you and I, it ain't happening any time in the next few years, in the next decade even, or forever. The good old rate back in 2021 at 3% historical rate, guess what? If you did not pull the trigger 2 years ago, that's your fault. You have no one else to blame. You and I been doing this podcast back in 2021. We tell people, look, housing prices were skyrocketing. Cash flow was amazing. The rates were 3.5% for investors 2 years ago. And people still refuse to listen. They did not pull the trigger. It's your fault out there, people listen. If you didn't pull the trigger, you could be jealous of people that did it. You and I and some of our investors that pulled the trigger back in 2021. So I know I touched on something in this topic. One more thing. Okay. I can keep going. Okay. Look, we do not want, okay, right now 7.3%. We do not want a mortgage rate under, in my opinion, under 6.5%. You know why? Because that will trigger more demand. And the supply of inventory will not going to be sufficient to meet the pent-up demand. At anything below 6.5%, I don't want that to happen. Think about it. If that would have happened, because more competition, more people can come off the sideline and going to beat up the prices again. If you think we are right now, the home affordability at the lowest, if you think the middle class and the lower middle class are being priced out right now from the American dream buying a house, imagine if the rate goes below 6.5%, all the wealthier people, homeowners and investors, they going to jump into the market. They will get all the inventory, and all the people, especially the primary home buyers, full-time home buyers, doing a VA loan or FHA loan or 5% down, or less than 5% down, but a regular loan, they can get priced out even more, right? Want to recap, remember what I just said. What are your thoughts?
I agree with what you're saying on rates, but I'm in the mortgage business, so hopefully they drop below 6.5. As a real estate investor, I see what you're saying. If rates drop down too, that's also going to spur a rally in values again. There's going to be more people come to the market, supply and demand situations that get even worse, and values will continue to move up. And look, real estate obviously ebbs and flows. If we have a major economic catastrophe, or is Seewing and I saying that real estate's going to be exempt to it and not have no? Of course it will. Everything will get impacted on a major crash. But if you look 5 years over 5 years or 10 years over 10 years, setting all those major economic events aside, or even with those major economic events, real estate will keep going up because that economics 101, supply and demand. So first thing we learn in 8th grade or 6th grade when you learn economics, supply and demand is what drives everything. Until that's corrected, real estate will continue to go up. And historically, it always does anyways. Same thing, because it's supply and demand and it's tangible and it's real and it's tradable. There is no plan at the moment to solve the housing crisis, and we keep getting deeper and deeper into the lack of supply issue, which means it'll take longer and longer to dig out of it. As I said at the start of this podcast, is we are heading towards renter's nation. No question about it. We're not here to argue about whether that's right or wrong, but we are here to say it's happening. What side of that divide do you want to be on? And it's sad that we're getting to this point in the world. It's like the Robin Hood days where they're barons and then there's everyone else, and it's a have or a have not. I don't know about you, but I don't want to live in the woods. I want to be a baron and have a portfolio of properties that will continue to build more and more wealth.
Said, great recap. We touched on a lot of topics. I got a little bit too excited. I spoke too fast. My accents gets revealed a little bit more. You and I are very passionate about this. For my investment side, this is our focus. Yeah, for those newbie investors out there that have been sitting on the sidelines, making excuses, we continue to the sideline. Year by year, you can miss out on opportunities, okay? You and I, we should discuss this 3 years ago. You and I discussed this 5 years ago. Happens every time. People take action, buy it in the right market, buy cash flow, surround themselves with a great team, turnkey providers, great property management, and sit tight and fight for the long term. And they are the ones that are the winners in this housing market, and the losers more they find. And losers in this market, any market, for over the years, they will continue to make excuses. They waiting for something to happen, or whatever. housing crash, mortgage rate come down, back down to 3%, whatever, they will continue to miss out. And 10 years from now, or people that miss out, they can say, oh, I could have, should have, would have done it 10 years ago. So don't have any kind of regrets. Take action, just be frugal with your money, have cash in reserve, and you qualify. If you have the credit, if you have the capital for down payment, buy a good market, invest for long term, 10, 15 years down the road. It takes time to create wealth. All right, that's all I have to say. Thank you, Richard, once again, for your great perspective. Thank you so much. And everyone, thanks for watching. Have a nice day. This is Seewing Yee. I'll see you on the next video. Bye-bye.